You hand your savings over to a commercial bank expecting them to act like, the actual adults in the room making rational bets on the future. But these same institutions are eagerly injecting autonomous AI agents into their core operations, letting algorithms approve loans while sprinting in the opposite direction if you ask them to finance the physical data centers keeping those systems alive.
Cash flow lenders demand immediate, predictable revenue to justify the loan, which AI facilities entirely destroy. Building a massive data center requires the land, the concrete shell, the fiber optics, and the power grid to synchronize perfectly. Utilities routinely fall 2 years behind schedule delivering a single substation transformer.
So you just end up with like a $500 million concrete shell sitting completely dark, generating zero revenue.
Commercial lenders cannot model that kind of physical supply chain failure.
Seeking a commercial loan for an AI data center feels like begging for a mortgage on a house where the local power company promises to hook up the electricity sometime next decade. They just stare at you and deny the application.
Single equipment loans hit $500 million due to constrained supply. Wait times for top-tier GPUs regularly stretch to like 9 months.
Yeah.
Nobody actually wants to own these chips since they become obsolete in 2 years.
So ownership is dead.
The industry shifted entirely to fair market value leasing. Companies rent the computing power and hand the rapid depreciation risk over to a specialized third-party financier.
Banks reject the physical hardware risk, but eagerly absorb the operational risk of the software generated inside it. Take Vantage Bank Texas. They partnered with Cavallo Technologies to build an AI lending assistant on Databricks. They hit 94% accuracy on complex lending questions.
They pushed lender productivity up by 87%. Lloyds Banking Group expects £100 million in value this year by pushing AI far beyond simple chatbot assistance. They are granting these systems autonomous transactional authority to handle fraud investigations and complex client complaints.
Handing transactional authority over fraud investigations to a large language model feels like letting your Roomba negotiate your salary. The bank's name is on the door, but if the AI hallucinates and ruins a client's finances...
Regulators face a complete liability nightmare. Software promises immediate cost reduction without capital expenditure. Banks avoid tying up billions in rapidly depreciating assets while integrating the output of those unfunded machines directly into their compliance protocols.
With banks tightening their capital standards and refusing to lend for critical infrastructure, corporate funding is migrating out of the banking system entirely. Businesses still need cash to, actually operate.
Private credit is aggressively overtaking a $41 trillion addressable market. Private funds step in where commercial banks refuse to tread. Banks originate the loans and immediately pay a private credit fund to absorb the risk of default.
Moving $41 trillion into the private credit market feels like emptying your insured savings account and paying a stranger in a dark alley to watch your cash. You no longer know who actually holds the financial risk.
The Basel Committee recently warned that excessive reliance on these risk transfers threatens the resilience of the entire financial system. These private funds operate outside normal banking oversight. A massive private credit fund collapsing during an economic downturn sends shockwaves hitting the originating banks and everyday depositors.
If traditional commercial banks outsource their physical hardware risk to leasing companies, hand their internal decision-making over to autonomous AI, dump their loan risk onto private credit funds, and abandon the corporate lending market entirely, what exact function do they plan to serve for you tomorrow? Goodbye.